they essentially, I tried to even get on Coinbase. Blue screen of death, service unavailable, middle of the day.
The advice provided on this podcast is general advice only. All statements made are considered by the participants to be accurate, but accuracy cannot be guaranteed. It has been prepared without taking into account your objectives, financial situations, or needs. All participants in this podcast, including guests, may have a financial interest in any or all of the products or services mentioned. Before acting on this advice, you should consider the appropriateness of the advice, having regard to your own objectives, financial situations, and needs. If any private products are detailed on this podcast, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future results.
Recorded June 23rd, 2017. It's the Money Path Podcast with Bob Iacchino and Mike Arnold, founders of Path Trading Partners. On episode 77, the What and the Why is sponsored by Motiveway. Go to pathtradingpartners.com and download your 14-day free trial. So let's join Bob and Mike with a conversation of news and the markets.
Paying very close attention to Comcast. We triggered with the close on Wednesday or Tuesday. The official close that triggered the double was 40.39, and the full target, this has a full target of 38.78. So if somebody's insane and wants to pick up Comcast stock, it did have a nice run up in May, but you could see this drop to. Our first higher target would be 39.21, so anywhere between 38.78 to 39.21. That's an accumulation zone. If you're interested in Comcast, right now it's sitting at its 50-day exponential moving average. So that's the Comcast, and those would also be the targets if you were shorting it. So, but that's at a wow. Right after the election, it was trading right before the election at 30.32, and it ran up 42.18. That's a pretty big run up for Comcast. Now it should backtrack a little, but I noticed that. Did you see this acronym stuff with stocks is getting insane?
Acronym stuff? What do you mean?
You have FANG, and then you have FANGed, and now there's a new one flying around this week, and I just think somebody's making this up to include more tech stocks, but it's called Fantasia.
Oh, come on.
Facebook, Amazon, Netflix, Tesla, Alphabet, Salesforce, Intel, and Apple.
Oh, come on.
So now you have Fantasia. I'm trading Fantasia.
What are they again?
Well, I'll do it in Facebook, Amazon, Netflix.
The way it's spelled, yeah.
Tesla, Alphabet, Salesforce, Intel, and Apple. And I don't know why they put an Intel in there because
they needed to spell Fantasia.
Yes, they need to spell Fantasia, and that's the only tech stock they could come up with because Intel's not looking so hot. It actually triggered a really nice trend line trade for us. Also, this is a tie-in too. 33, about 75 area is the target for the short trend line trade. So that could be a good place to actually pick up some Intel. Intel's dropped off its highs earlier this year, back in January, 38.45. So that could be a really nice a pullback to, and that's a key support for Intel. So if you're a Fantasia trader and wanting to pick up Intel,
Facebook, Apple, Netflix, Tesla, Fante, Alphabet, Fante, S. What's the S?
Well, that's Salesforce.
It's Salesforce? CRM is Salesforce?
Yes. Okay. CRM is Salesforce.
All right. Why do they put Salesforce in there?
They needed an S. And they're not going to put Sprint in there. Although Sprint...
Can we create a Fantasia index? Can we start today?
You know what's interesting? Let's go through these stocks because so many people follow them. Mm-hmm. Facebook, it had its breakdown. It's nearly back to its highs. So that's Facebook. Let's go. Amazon set a new high this week at 1,017. So that exceeded it, when we had the flash crash of the FANG stocks. That's back to setting new highs. Netflix, LX. No new high base. We have a cross in the rotations on and it's basing down. It's so Netflix is not looking very strong and not anywhere near its new highs. Is right now trading 154.89, high of 166 before the flash crash. Tesla, you want to make a bet on Tesla? New highs.
Yeah, that's easy. Easy enough.
And we'll get to that later in the show, why Tesla's probably at new highs, which is absolutely ludicrous. But Alphabet or Google, not.
We really got to stop doing that, by the way.
What?
We really got to stop saying it's crazy that it does it because it does it.
No,
I know what you're saying. I understand what you're saying. It's insane that it has no, but like I said that for years about Amazon. I mean, you got to realize Amazon, Amazon's been around since the 90s. And everybody said the same thing. When are they ever going to make money? The valuation's crazy, blah, blah, blah. And it's been around since the 90s, that stock.
We're not saying Tesla's going away. We're just saying
I'm saying Tesla's
it's value.
Huh? I'm saying Tesla's going away. I'm just saying we got to stop saying it.
I like to say it. I didn't say all new time highs, though. Google, not back to all new time highs. That's off its top two. So Salesforce, what was that? I keep wanting to do. What was Salesforce again? I just blanked out.
The stock symbol?
Yeah.
CRM.
CRM, that's right. I was
customer relations management.
All right, Salesforce nowhere back to new highs. A lot of these have done a 50% retracement from their recent highs to lows. So the only ones so far, we have Amazon, Tesla, Facebook not quite but close, Intel nowhere near, and Apple is not anywhere near. So out of the Fantasia stocks, we only have 3 that are acting strong at this point. And a lot of these are setting up for potential shorts or to head lower for lower accumulation. They should have, though. They could have put T-Mobile and Sprint in there because there's now the rumor flying around that T-Mobile is looking to merge with Sprint. Sprint jumped up, so that would cover the if Tesla ever falters, you'll put in T-Mobile, which is TMUS, and Sprint for Salesforce. But then when they merge, you're back to having a problem.
I need a company that has a U, I need a company that has a P, and I need a company that has a D. Real quick.
So wait, say that again?
A company with a U starts with a U, like UBS.
Or
okay.
UPS, or UPS. Under Armour.
Or Under Armour, UA. Under Armour.
Okay, great. Peapod? Does that work for a P?
How about you want Prepod's a joke? How about Procter Gamble?
Okay, great. Give me a D.
P&G.
Give me a D.
D. You could do Delta, DAL. You could do.
Here's mine.
Delta.
Salesforce, Tesla, Under Armour, Procter & Gamble, Intel, Delta.
Stupid. Let's do the stupid index. Trade stupid, everybody.
Well, then, see, if you said you needed a D,
very diversified,
I would have put in. If you said that was going to be stupid, then I would have put Deutsche Bank in there. I would have.
Right. That's very diversified when you look at what that's covering.
Stupid is smart.
We got Salesforce, which is customer relations, so it's tech, right? We've got Tesla, which is stupid. We've got Under Armour, which is, sporting goods and apparel. We've got Delta, which is
Snap in though for stupid also.
No, you want it to be.
I don't think he's trying to make it stupid.
Right,
I think he's trying to just spell stupid.
Right.
I want it to be stupid.
It has to be ironic. The stupid trade has to be brilliant and be a safe, diversified fund.
All right, Mike, can you just track those 5 every day? Is it 5 or 6?
Sure. Should I do daily stock updates for the stupid index?
No, let's track it. What if it beats the S&P this year?
Oh, God.
It's very diversified.
Then you're going to track it.
We've got tech with Tesla and Intel, right? We've got, it was Intel used for I, right?
Yeah.
We've got airlines, travel with Delta. You got to make me the spreadsheet, but I'll track it.
And in further news,
maybe we put in Dominion Energy. No, I'd rather have Dallas.
Yeah.
I'd rather have Delta. We got the athleisure trend with Under Armour. This thing's gonna kill.
Oh boy.
We'll have $1 billion in there.
It's an evergreen YouTube chart that we own.
It's gonna kill, Mike.
All right.
Are you tracking it? Starting Monday. Just make me the spreadsheet. I'll put the prices in every day. All right, email it to me. All right, we're done with that.
Okay, another one we could have.
I will give you all a stupid update every podcast. You just got to make me the spreadsheet. How hard is that for you? Take 5 minutes. Come on, don't be stupid.
You were waiting for that one, weren't you? Another one that set new highs before the tech sell-off. It's not a FANG and not a Fantasia. eBay has not recovered its new highs, but did you now see this? eBay will now match Amazon, Walmart's, and others' prices on over 50,000 items.
How are they going to do that? They're an auction site.
No, but they have a little bit of they have 50,000 items across the site that will have the price match guarantee. There's certain select areas that they actually sell new things, like unopened items sold through eBay deals. So anything through eBay deals, which is a daily thing, that if there's an eBay deal that's higher than Amazon or Walmart, or I guess maybe Best Buy or something else, then you can email it in and say they'll match the price. So,
to be honest, this is how, to me, how far off the radar eBay's fallen. I didn't even know they sold new things. Granted, I'm not at the forefront of
Can you give us the 30-second snapshot on crude, because it's had a pretty big down week?
Yeah, crude oil actually had a slightly bullish EIA report. There was a larger draw than expected on both crude oil and gasoline. We're now lower in price than we were when OPEC announced that they were going to cut production. So they've essentially, OPEC and their partners cut remember, this is 1.8 million barrels a month. It's not just they took 1.8 million barrels out and see what happens. This is a month that they took it out, starting in January. We're now at the end of June, and it's been extended through next year, and we're lower than we were when they announced it. Demand has been slow to pick up. The summer driving season has been nowhere near past summer driving seasons in terms of use. Whether that's because of electric cars, I doubt it, or just people driving less because maybe they have more money and they're flying. Jet fuel doesn't seem to be spiking either, but planes are getting more efficient, although I don't think at a rate that would affect it in the numbers yet. It feels like a bottom is approaching. The only piece of bullish news out there, though, is that there's two pieces, and they're kind of related. The high productivity, low cost wells are nearing the end of the line. We may get another rig count rise today. We may not. It's now, I think, 22 weeks in a row that we've got oil rig rises from the Baker Hughes numbers. We may get another rig rise today, but the efficiency of those rigs is starting to fall. And with horizontal drilling and fracking, it falls off a cliff. It doesn't just it doesn't trickle off. When a well is past its max efficiency, it goes to inefficient very quickly. It's just a different type of drilling. So, and land in the Permian, which is the most successful shale area, is getting really expensive, just like anything else. When something is successful and in demand, the price goes up. So those are the only two pieces of bullish news that you can see. So I could see prices being higher down the road, but not anytime soon.
Back in the 50s?
Yeah, I'm saying 50s. It's not something I would trade, but you could potentially see us hit $60 to $65 in late 2018, but it would take that long. Because the money now is getting tighter and tighter for the frackers, and we haven't had that big of a range. People might think, what are you talking about? It's basically been 55 to 42, and that's all it's been, right? But the difference between 50 and 40 is big on a percentage basis. It's 20%. So you're not looking at a small amount of profitability being ebbed away when we get down to the lower 40s. They're still profitable. But will they buy more expensive land in the Permian and start the more expensive process of opening new rigs, brand new rigs that can be very efficient when they come out at $38 a barrel? They certainly won't do it as aggressively. Now, having said that, we've still got contango in the curve. so they can hedge some of this price risk out if they choose to. But the numbers I see, we haven't seen a ton of hedging. People have just kind of been drilling and selling. So we'll see. There's not a lot of bullish news out there, but we're probably nearing a short-term bottom. I just don't think we're there yet.
Well, there's our crude update.
That's pretty efficient.
That was very efficient.
Like that.
Something I didn't put the whole article in. We can switch to cool tech, though. But since we're talking about Intel, I was reading an article this week with Intel just signed a deal with the Olympics for the 2020 and 24. It's a 7-year deal, but it'll apply to the 2020 and 2024, where they're going to be the supplier of drones and virtual reality to broadcast the games, the Olympic Games, in a whole new way, from a whole new point of view. So
Olympic game drones.
Yeah. Now this is actually very interesting. Have you used these sites where they ship you clothes, Bob? And
I have used those.
Because my wife, that's the only
Trunk Club and
shop anymore. She uses Stitch Fix and everything, but she stopped using them recently because she's like, well, I like this, but then I don't like this. Can you send me this? And they're like, no, we'll only send you what we want to send you. So she was frustrated. So she was excited this week. Amazon Prime Wardrobe lets you try and return clothes for free. So what you're doing is now you can pick out from various things. You have to pick at least three items and up to 15 from their fashion stuff. They'll ship it to you for free in your Prime member, but you don't pay for it. When you get it, you have then 7 days to try it on. It's actually going to tie in with if you need help and advice, that new camera thing they released that I guess you can try on fashion, and they have fashion consultants standing by to help you with fashion consultants. It works with that too. And then if you want stuff, you keep it, and then they charge you. And if you don't, you just put it back into the prepaid box label thing, and they just come pick it up off your doorstep. If you save at least 3 items, you get a 10% discount. If you keep 5 items, you get a 20% discount. So what isn't Amazon getting into now?
Can we say that Amazon is going to buy either CVS or Walgreens? Because what are they not in that they want to be in?
Hold on. Well, you just had Citibank just came out this morning and says Amazon unlikely to buy an auto parts retailer. so there's something that
back to the clothing thing. There's an app I used called MTailor, and it is now deleted from my phone because of this Amazon thing. MTailor is one where you go through a little process where you set your phone up on the floor, you hit their app, and you put your arms out to your sides and you spin slowly, and it scans your body. So the clothing app thing, I've used, I forgot what the other one's called. I've used Trunk Club. There's another one called, it doesn't matter, but you're right. They send you stuff they want to send you. The beauty of Trunk Club 2 years ago was that you went in and you met a stylist. You actually went into the office, met a stylist, talked about what you liked and don't like, and you don't like, and they bring you clothes and you're like, yeah, I would never wear that, but I would wear that. And they theoretically get to know you and send you stuff. But I like the idea of actually picking myself. But as a guy, again, the beauty of Trunk Club was if you don't know fashion and you actually want to look somewhat current, they help you do that. And Amazon has that feature as well. So at some point, you have to think the Justice Department isn't going to like what they continue to do because they're in everything. But their model is to get a small share of everything. Their model is not to dominate any one thing. So I don't know if the Justice Department would have any success.
So the shipping industry, which, Amazon's going to have
also in
building their own shipping thing. Here's what I'm thinking, though. Well, let me get to the earnings first. So the earnings per share of $4.25 on revenue of $15.7 billion. Their estimate was $3.89. So $4.25 beat $3.89, and the $15.7 billion revenue beating $15.56. So they are handily still doing. I think either FedEx and UPS should merge with Target. You should have Target, FedEx or UPS, and then Target still needs a more, maybe a Home Depot or a Lowe's, because then you could have the appliance aspect. Target still got, or maybe throw a Best Buy in there. So you get all these conglomerates merging that have their own infrastructure, and they have the shipping thing, and then that's the only thing that left can compete with Amazon and Walmart.
Well, you know what's interesting to me about Amazon is they're not just like, there's origination sellers on Amazon, right? That's what's so cool about what they're doing. So one of the things that's interesting about, and why the Justice Department probably will never get in there, is because they've become sort of the place you go to shop locally as well. But Amazon is your locale. That's the difference. So like a bunch of small sellers, a bunch of small companies can actually compete with Walmart because they're on Amazon. I mean, that's the trick, right? So you're not going like the downtowns in these small towns. Yeah, they're not, their little hardware store is gone. But that little hardware seller, in theory, Amazon has replaced them like Walmart did with the big box. Well, like if you're a crafts person, you can sell it on Amazon. Someone's looking for a hand-carved, I don't know, cedar horse. It's not Amazon making those. That's what's so cool about what they're doing. Eventually, everyone's going to be housed in an Amazon-like environment, and they're not going to have to pay rent. So I keep thinking, like, I drove through an area that I grew up in, part of the area I grew up in a couple days ago, and I was just looking at all these vacant stores, and I passed one that I remembered, and he was kind of like this guy that built speakers out of old luggage. He would collect vintage luggage, and he would build speakers. And it was a popular place to go kind of hang out because there was always music coming out of the speakers, And he was a craftsman, right? And I'm like, it's so sad that he's closed. And I get home, and sure enough, he ain't closed. His store is closed. He sells on Amazon.
Well, Oracle's not doing too shabby. They released earnings this week. We had a really nice horizontal channel pattern that did not trigger and reached its full target on Oracle's release of earnings. They blew it out of the water. Earnings per share, 89 cents, came in versus 78 cents expected. Revenue, $10.9 billion versus $10.5 billion, so they beat both top and bottom line. And their subscription software reached more than $1 billion for the first time ever. So they gapped up from around what was the close before they released earnings. Oracle.
All right.
Which I said we had a really nice horizontal channel pattern set up, and it went to full target on earnings release. Seems to be doing quite well. So maybe we should have put that in, or we should have another index with Oracle in there.
Larry was a very frequent guest on that show. Jim Cramer was a very frequent guest on that show for a long time. He's 72 years old now. That's unbelievable.
A stock we're not putting in there, though, is Bed Bath & Beyond. It did the exact opposite. They released earnings. First quarter comparable sales down 2% versus estimates of up 0.3%. First quarter earnings per share, 53 cents versus estimates of 66 cents. And net sales, $2.74 billion versus estimates of $2.79 billion. Management said it experienced softness in transactions in stores, as well as higher net direct-to-consumer shipping expenses, coupon expenses, and advertising costs. And they went from mid-33s to 30-20. They dropped about 10% on that news. And that's another retail apocalypse story. Wow. They were trading in 2015 at $79.64, and now they're down to $29.59. They haven't been this low since 2009. Wow.
They're imminently replaceable by something like Amazon and eBay. Well, I'm sorry, when you used to look for sort of that quirky thing, even some of the as seen on TV stuff, Bed Bath & Beyond was the place to look. Now it's the internet. You can get pillows and cushions and placemats, and it's just so much easier.
Well, speaking of something we'll supposed to be talking about as it heads lower, although it tested its $17 mark again this week, right now trading $17.59. I don't know if this is going to turn around Snapchat either. Snapchat launches its location sharing feature, Snap Map. So Snapchat's next big feature wants you to get you to meet up with friends in real life rather than just watching each other's lives on your phones. Snap Map lets you share your current location, which appears to friends on a map and updates when you open Snapchat. Can't you already do that like on everything, like with your iPhone or your Android device, like share your location and if you're with your friends and they can see where you are either one time or constantly updated? Why would I go to Snapchat to do this?
So Tesla.
So what do you think about Tesla's going to start a music streaming service?
They are not.
Yes, they are. Because they want to control the experience in the Tesla car, and they want to be able to have a music streaming service.
I love they want to control the experience, yet we're still picking the songs. What are they controlling? How good they sound?
So, oh, did you put this in Stafford in the going to zero and fraud corner?
Got you pulled everything else I put in there, Mike, but you missed this?
No, this is fine because actually I wish the state of Illinois could go bankrupt because that's the only thing that's going to save it. Their whole now this ties in. You're going to see this a lot in the news over the next few years with all these unfunded pensions and everything else. The entire state budget now for Illinois, 100% of it has to go to just fund the pensions. 100%. They have not even been able to keep up with it. How much has the market rallied since 2009, Bob?
200%?
Well, the Dow wasn't. I mean, the S&P was down to.
You keep talking. I'll figure it. Go ahead.
The S&P, I just know, was down to 666 was the low, and now it's trading 2432 as we speak. So that's
over 200%.
That's close to four. Not quite yet, but it's close to 4 times increase.
All right.
So we've had the broad market, increase 4 times, right? And the Dow's roughly 3.5 times.
Right.
Well, Illinois' pensions have become more and more underfunded. They say they need 7% guaranteed per year, but they haven't even hit those numbers with this massive rally. What happens if we have a pullback or anything else? And it's taking the whole state budget to just fund the pensions. There's no way out of this.
No, there isn't.
And you can't declare bankruptcy as a state. And the judges ruled that you have to pay these no matter what. What are they going to start doing? I mean,
the approximate annual return on average for the S&P 500 since 1928 is 10%. When you add in inflation, it's more like 7%. It's a little under. It's like 6.8 something. And when you add in dividends, if you were to reinvest dividends, it jumps back up to slightly above 8% a year since 1928. And when you see they want to invest our pension funds in the risky stock market.
SpaceX, this is interesting. This is tying with the government, how screwed up our governmental contracts are. So the U.S. Air Force has revealed how much the government can save by having SpaceX launch some of its satellites instead of relying purely on the United Launch Alliance. It shows that the U.S. will expect to pay as much as $423 million per launch by the year 2021 if it allows the ULA, the United Launch Alliance, which is Boeing-Lockheed joint venture, to have a monopoly on its launches. Versus right now, it's right to launch through SpaceX. Currently, it's $83 to $96.5 million. Roughly, if you go through SpaceX right now, it roughly costs $83 to $96.5 million to launch its GPS satellites in those fiscal years, and it's going to go up a little by 2020. But you're looking at saving roughly $300 million per launch by going with SpaceX instead of the Boeing-Lockheed alliance. And I mean, that's not. Elon tweeted out this week, and I did like this tweet, that the price difference of $300 per launch means the client satellites are basically free. So if SpaceX can do it, I mean, for this cheap, why wouldn't the government just go, okay, launch all our stuff? In further Elon news this week, he says Los Angeles is open to use his traffic tunnels, which we talked about with the Boring Company. He's now in discussions with the Los Angeles mayor about actually using these boring devices to tunnel under LA to reduce traffic congestions, which I still say that anything in California is probably one of the worst places to start off tunneling underneath.
Think.
Just because you know it's going to happen.
They're overdue.
And then we'd have the mega quake.
You look at stories on seismology, and California's overdue.
Yeah. And so I'd probably start somewhere that didn't, if you wanted to start actually putting tunnels under places for people to drive in and your self-driving cars, California would not be my prime pick. Anywhere in the Ring of Fire would not be my prime pick. Japan would not either.
Yosemite National Park, bad idea.
No, see, well, when that super volcano goes up, then we're gonna have bigger problems anyways. Remember, Tesla brought in the Swift programming language creator just 6 months ago. He's already out. He said it. He tweeted this week. Yeah, he's out. Turns out Tesla isn't a good fit for me after all. And he's gone. He was a pretty smart guy. And this position reports directly to Elon, and he hacked it for about 6 months and said goodbye. So Elon's bringing in a new director of AI and autopilot vision, he's hired. I cannot say this name. Can somebody say his name for me? I don't want to butcher it.
Which one? This Andrej Karpathy?
Yes. Who's one of the world's leading experts in computer vision and deep learning. Cryptocurrency segment, because we did have a flash crash in Ethereum this week, which was based, they're blaming it on an ICO, or an initial coin offering, that went very wrong. It clogged up the whole network and prevented normal transactions from getting in. So you actually saw Ethereum dropped from like 300 and something down to 10 and then it dropped again from 300 something down to like 80, and then it bounced back up, which I'm thinking for a long-term strategy, I got to figure out how to do this. I'm going to just put these ridiculous resting buy orders in at these cryptocurrencies. So if we get these kind of flash crashes or obscene things, just pick up a little.
Just a little.
What did you call that whole? What do you call it?
It is the Wild West. I've been doing some trading now on it, and it's very interesting because we can trade these things pretty well, but you have to again choose your exchange you're trading on. The charts between different exchanges look differently because there's no central clearing of it, and there's no central price. Bitcoin or Ethereum can trade slightly differently on different exchanges. And it is the Wild West when you get stuff like these flash crashes. We did mention these ICOs a couple weeks ago, and I wanted to retouch. Actually, before this flash crash, we were going to talk about it this week. But an ICO is just you can do it through other cryptocurrencies, but it's really based on Ethereum because this is what Ethereum's designed for. ICO is an initial coin offering. It's a way to raise money. So instead of like issuing stock, an ICO company sells a number of cryptocurrency tokens. They're not selling Ether or Ethereum. They're selling these tokens, and each ICO is a little bit different. There's a set time limit for the sale and a set number of maximum tokens that will be sold. Once those limits are reached, the sale is done. These tokens are different from shares. They can be traded and they have value. And after a successful ICO, this can easily double. But these tokens don't give their owners ownership over part of the company that issued them. Each token is actually a smart contract that can provide additional benefits down the road. For example, they're tokens issued by a company called STORJ Storage, a decentralized storage solution, and those tokens can be exchanged for storage space in the platform. But a lot of people change these tokens, they buy them, and then you can change them back into Ethereum. So they get in this ICO, and then they immediately the value of these tokens go up and they change it back into Ethereum. So it's another way to trade it. Problem is these ICOs are so in demand for subscription and so many people are trying to pile into it. It's like trying to get, where they have those ticket sales at Ticketmaster, and they're like, we're going to open it up and everybody's going to go online at 10 a.m. and there's only a limited number of tickets and the whole network goes down and only a few people get tickets. That's what's happening with these ICOs. It's pretty much a gamble whether you'll get it or not. And there's such a poorly run ICO this week. It pretty much took down the Ethereum network. And Coinbase, which people can trade and buy and sell Ethereum on, they essentially, I tried to even get on Coinbase. Blue screen of death, service unavailable, middle of the day. So this is why I call it the Wild West, not only with trading stuff, but, working with these cryptocurrencies, because it's still getting worked out. It's still the reason I like Ripple a little more, because of the backbone's solid, but all of these different cryptocurrencies have their weak points. And you sometimes don't know what that weak point is going to be until it breaks.
Well, very quickly, the lesson to be learned from the Wild West analogy is the Wild West were settlers that went to go mine gold. Then came the robber barons who built the railroad and the towns. And then the third wave was the lawbringers. So the question is when do we tip from the Wild West to the robber barons?
I think we're pretty close. NASDAQ had a story on cryptocurrencies this week. Bloomberg had a feature story on cryptocurrencies this week. Those are the robber barons to me.
Yeah.
You're going to have, there's a fund out there, and forgive me because the name escapes me right now, but they're coming up on having $2.5 billion, and they use artificial intelligence and quantitative methods to choose investments, not just like high frequency trades. And in one of their funds, their largest holding is Bitcoin. So you're starting to get the robber barons pouring in right now. And the interesting part about it is, it seems to me, because, and I'm going to go into this a lot more in my why, but our price action stuff works really well in the cryptocurrencies that are liquid and tradable. And Mike's been doing some bat chats on it, and I think we're 5 for 5 or 6 for 6 or something. And it's small piece of data, but again, I'll go into that more. The speculation that's going on in there now, it seems to me that the people who understand the technology don't understand trading, and the people who understand trading don't understand the technology. And so it becomes a very speculative game. And the robber barons will come in there and they will rob big. It will be big what they make
and
from
unify it, and also make it stronger, because the railroads built the towns and created all those jobs. But then the lawbringers come in.
I'm worried about who the lawbringers are going to be.
I just keep referencing the philosophical irony of Bitcoin being developed under this idea that it's not controlled, yet we are going to need them to stabilize it.
Oh, before you go there, we should have a new acronym for SMART, but put the dumbest stocks in that one.
Snapchat's number one. SM. What's an M stock?
The worst M.
It's got to be a bad M stock. That's the hard part, right?
Well, so when you invest... Macy's.
Macy's is good.
Macy's
is good.
SMA. What was good for A?
Abercrombie and Fitch.
Yeah.
ANF.
Yep, that's pretty bad.
Abercrombie's terrible. It's at $12
R.
On site. What could be an R? A bad R. Red Hat? How's Red Hat doing?
Red Hat's doing quite well. They actually, speaking, it was not in the earnings segment that they released earnings this week, and they also blew it out of the park and gapped up to a high of 100 from.
Okay, so not them.
Huh? So it's they
Rite Aid.
Right.
RAD, Rite Aid. The only pharmacy no one goes to anymore.
Yeah, I don't.
Rite Aid's at like $3.
And the T.
T's AT&T.
No, AT&T, you can't do that. It'd have to be. It's got to be Twitter.
There you go, Twitter.
So here's the phrase that pays: if you're smart, It's stupid. If you're stupid, you're smart.
We're just keep coming up with all our. How many of these are we
Mike, I
going to
need
track?
2 spreadsheets, Mike. 2 spreadsheets before Monday, because I got to track them starting Monday.
The stupid fund and the smart fund?
I invest stupid, and in the back, I don't invest smart.
This will not be, I don't want Mike to make a reinvesting of dividends spreadsheet, so this will just be price. It's not a dividend reinvestment plan.
Good, because you weren't going to get that anyways.
Send me the 2 spreadsheets. I need the spreadsheets. It's going to be on the show, so people are going to be asking.
All right, well.
By the way, the Fed's Dudley. Which one is Dudley?
I wanted to talk about Neil Kashkari first. Did you see his blog
extra
post?
A in there. It's Kashkari.
I like Kashkari.
All right. No, I didn't see his blog post. Go ahead.
He wrote a really long blog post. He was the one dissenter, right? So he explained why he dissented, and he said, for me, deciding whether to raise rates or hold steady came down to a tension between faith and data. On one hand, intuitively, I'm inclined to believe that the logic of the Phillips curve, a tight labor market should lead to competition for workers, which should lead to higher wages. Eventually, firms will have to pass some of those costs on to their consumer, which should lead to higher inflation. That makes intuitive sense. That's the faith part. On the other hand, unfortunately, the data aren't supporting this story, with the FOMC coming up short of its inflation target for many years in a row, and now with core inflation actually falling even as the labor market is tightening. If we base our outlook for inflation on those actual data, we shouldn't have raised rates this week. Instead, we should have waited to see if the recent drop in inflation is transitory to ensure that we are fulfilling our inflation mandate. So he's torn between data and faith.
Are you ready?
Yes.
What does he look at when he decides what the effect of rate hikes or rate cuts are going to be? What does he look at? Past data? And he makes projections.
Yep.
So he relies on projections for what the effects of the policies that he makes are going to be. But he's not ready to rely on the projections of where inflation is going based on the data he has. He needs to see the data before he moves into a state of relying on faith. This is what I don't like about these kinds of conversations. The same kind of conversation that goes on. Yeah, I'm going to mention politics again. I'm sorry. But when they talk about, we don't believe in dynamic scoring for the budget. We need it to be actual numbers, but we believe on dynamic scoring for climate change estimates. So these guys are all, Kashkari is a relentless self-promoter. That's what he is. He's the only Fed guy that is constantly pushing. I bet you he's got a press secretary. I bet you he's got a PR person. He's constantly pushing out his blogs explaining why he thought what he thought. He's a self-promoter is what he is. The data right now is not showing that it's going up, and I don't want to rely that it will go up based on what I'm seeing. Okay, great. Well, we're going to hike rates because we need to slow it down. That's the same thing. You're relying on the faith of what you believe is going to happen if you move rates based on the current data, but you're not willing to. Look, I don't think they should have raised rates either, given where the numbers were. I'm just saying all this guy does now is self-promote. And he is starting to bug me. He's starting to annoy me because it's like, just shut up and work. Blog post, wait till you're asked the question and then answer it. That's a traditional Fed governor and Fed president's role, is to be in the background. Kashkari doesn't want to be in the background. He wants to be in the foreground.
How many of these guys truly want to be in the background, though?
Well, I think they all do. Like, seriously, who can name them first and last name and where they're from?
Well,
I can name Neil Kashkari from Minneapolis really easily. I know Lacker, Harker, Dudley, Williams.
Evans.
I know Evans because he's Charles Evans from the Chicago Fed. I don't remember Lacker's first name, and I don't remember Harker's first name because I mixed them up. One of them is from Philadelphia.
Patrick Harker's from Philadelphia.
Okay, where's Dudley from, and what's his first name?
I don't know. Dudley.
Where's Williams from, and what's his first name?
I blank out Dudley because it sounds like a guy whose last name is Dudley shouldn't be in charge of money stuff.
It sounds like a Canadian Mountie cartoon.
Yeah.
Look, my point is we don't generally remember who these guys are because they're not in the fronts. They don't put themselves in front. They don't. Kashkari does. Anyway, Dudley, whose name I don't remember and where he's from, said that wages and inflation should pick up. He called weak productivity growth a fly in the ointment. I would say it's bigger than a fly, wouldn't you? It's a little more important than a fly in the ointment. It's more like an elephant on my blueberry muffin. Flattening of the yield curve, not a negative signal for the U.S., except it always has been, but I guess now it isn't. Mike, what was a negative yield curve always the sign of?
A recession.
Thank you, but now it's not, according to Dudley. Halting tightening cycle now would imperil the economy. Rick Santelli agrees with that. Fed doesn't want to slam on the brakes cause recession. Okay, that's a millennial term that has now made its way into financial news.
What was that?
Oh, cause recession. Fed doesn't want to slam on the brakes and cause a recession.
So are you asking?
Dudley said Fed doesn't want to slam on the brakes because it will cause a recession. It says here, cause recession. I thought that was those cause recession things that the young people say now. He also said halting the tightening cycle now would imperil the economy.
I don't get that. How?
I don't know. I don't know, because before tightening, this would imperil the economy.
Now,
so I don't know. Yeah, now not tightening imperils the economy. So I don't know. I don't know. I do not know.
Then you had Kaplan.
Well, I skipped Evans because Evans probably said that we should not reduce the balance sheet or hike rates. Let's see. Evans, going to take over 3 years to get the balance sheet down. Okay, so pretty much within that. Kaplan, which one is Kaplan? Do we know?
I don't remember which one he was.
He played from Welcome Back, Kotter.
I loved Gabe Kaplan.
Is he Dallas? Is he Dallas? Yeah, he's Robert Kaplan.
Robert Kaplan from Dallas says technology globalization is holding down U.S. inflation. That's true. I've argued in past podcasts that we are in a deflationary permanent cycle.
Maybe they should just say Amazon's holding down inflation.
Nobody pays full price for anything.
They'll blame it on Amazon.
By the way, if we have anyone from Nike or Converse that's listening to the show, I have been avoiding buying new Converse Chuckets, which are the Converse without the laces, simply because I can't find a big enough discount yet. If anyone's listening from those organizations. Moving on.
Hit us up on Twitter and get us those shoes. I'll take Vans.
You skater. Kaplan says technology global. I agree with that, holding down inflation. Kaplan says universal income should be studied, but hopefully it won't be necessary. It will, hopefully later rather than sooner. Kaplan says Fed is accommodative, but probably not as accommodated as people think, which I think is correct given the deflationary cycle. Philadelphia Fed Reserve Bank President Patrick Harker, there's why you knew his name, tells Financial Times it is, what's that?
I knew that one.
You knew that one. Tells the Financial Times it is prudent for us to pause on the next rate increase at some point. I would assume it is this year. Cease reinvestment and see how the markets react. We can take our time to do this. We don't have to be in a rush. I believe, as we sit right now, that when they pick a date to start to reduce the balance sheet, which again means halting reinvestment of maturing securities, it doesn't mean halting the purchase of new ones. They'd already done that. That was called the taper. So they already stopped buying new stuff. But every time something expires, matures. So this has been going on since about 2008, maybe. So we're in 2016 or 17 now. So we're 5 years, or I'm sorry, my math. We're 9 years on from when it started approximately. So like a 5-year bond expires, they get the money for that. They take that money, they buy another 5-year bond. So they're going to stop doing that. That's a lot of money coming out of the economy. I would argue that when they do that, that will be a temporary thing. They will halt. They will start to reinvest again, because I think that's going to hit the market really bad. The Fed is about to get to what they stated was 50 billion less purchases. Are we all ready to buy those? You ready out there, market people, to buy 50 billion more in securities that yield under 3%, under 5%? Is everybody ready for that? Illinois can't buy it. They need 7%. So I think that's going to hit the market really bad when they start doing it, and I think they'll start it and then stop it.
Well, But I thought their mandate wasn't to watch see how the markets react. So is it all market-based now? That's what...
Yeah, because that's the only thing that they can... I think we've realized now that the only thing the Fed can control is what the stock market does. They're not able to move the needle on housing necessarily. They're not able to move the needle on jobs. They're not able to move that needle. That needle has to be fiscal, not monetary. It has to come from the federal government. And by that, I mean the federal government backing out of things, rolling back regulations, and letting business run. And they're starting to do that, most that we've seen in a long, long time. The Fed can't do it. So, yeah, they kind of have to look at the stock market. They'll never admit it. But I think you and I agree, Mike, that's what they're doing, right?
Yeah. Well, they're blatantly saying it now. We're going to see how markets react. So if the market sells off, you stop.
You're right. That's the quote you put in here. And see how the markets react.
Right. They're blatantly saying. It's not how to see. I think they're whole data dependent at this point. The other data they watch, I think, is just for amusement's sake, because they really is the market going up or down. Dude, what we do, see, they've raised now a couple times, right? And the market hasn't really reacted that much.
Agree.
But whether it's raising stuff, whether it's unwinding the balance sheet, once something has and I'm not talking about like a 2 or 3% pullback, but if they see the market come pull back 10%, whoa, that's off the table. Which I'd argue also that, where did all this money that poured into tech stocks come from at the end of the 90s was another mini Fed-induced bubble, but that's another thing for a different time. Meanwhile, for right now...
You have to look at the stock market in the context of inflation. If, they say if inflation is at the higher end of the band, say it's a 2.2, 2.3%, and the stock market is running up, they're right to point to it. Because asset inflation and price inflation are two different things. First of all, the definition of inflation is monetary expansion. It's not prices. But in today's world, we now call inflation price increases. So that's fine. We'll use the modern definition of it. Inflation of asset prices is still inflation. If it's not tied with price inflation, the price of goods, then it shouldn't be in the Fed's purview. But at the time when Greenspan made his irrational exuberance comments, we also had sort of a heating up of price inflation as well, which is what they're supposed to be controlling. But in theory, if they're just supposed to be watching controlling inflation, right, asset inflation fits in there. So, and I think they're leaning more toward that because price inflation is not happening.
In headline news, the market manufacturing PMI was just released, came in at 52.1 versus expectations of 53, and services PMI came in at 53 versus expectations of 53.5. And market just came out and said the PMI is running at a level broadly consistent with a 1.5 annualized GDP. And
yeah, it's great if it stayed there. Probably won't.
Bank of America just came out with its revised 2017 GDP forecast and just slashed it to 2.1.
From what?
They were like at 2.9 or something.
Yeah, I guess that's a slash.
That's a slash.
I hate when the media says they slashed it from 2.3 to 2.1.
1%.
Yeah, exactly. No, so they were calling it a tech wreck 2 Fridays ago when the NASDAQ fell less than 2%. Tech wreck! Anything new on Brexit?
Yeah, we had British Brexit Minister Davis says a long way to go in Brexit talks, but off to a promising start.
Yeah, the British say that. No, it's going great. Going great. Everything's fine. The EU is not commenting the same way.
No, and they also says Britain will leave single market customs union. Oh, with the senior EU officials said that after the first day of Brexit talks, London still questions whether there's legal basis for exit payments to the EU.
Yeah, it's not going well. It's not going to go well. I have a friend who does EU studies, and she said that the Europeans in this kind of an area, they take offense to a level that nobody else does. They're personally offended by Brexit. So everything is going to be with the background of, we're mad at you. So they take personal offense to stuff.
We talked about McDonald's last week with their trying to hire via the Snap app.
Fresh meat.
They're now replacing 2,500 human cashiers with digital kiosks.
There you go.
So all these people, I guess these were very temporary jobs they're looking to hire.
So a friend of mine started her 15-year-old daughter working, got a legal permit for a 15-year-old to work, and is working every Sunday at this Italian bakery cafe that I know of. And kid's making minimum wage, right? And was making sandwiches and stuff. And this is a fairly well-to-do family. And, I said to the parents, I said, why are you making her work? You guys don't need the money. And he said, we just want her to know what it's like to earn your own $80 and to go out and spend it. She, as a matter of fact, the day before she started working, she was at a store, and she FaceTimed her mother and said, Mom, what do you think of this outfit? It's really cute, but it's like $40. And she goes, I don't know. It's your money. Is it worth it to you? Is it worth it? She goes, well, I got to work like 8 hours to make this outfit. Bingo. There's why I want my kid to work. That's what she said, right? She's starting to relate the amount of time it takes her at work to earn that outfit. Family on the same block, because I was at a barbecue, right? Family on the same block said, yeah, we were thinking of having our 17-year-old go to work, but you know what? She's only going to make like $8 an hour. What's the point? Well, the point is to know what your skill set is valued at. Is it valuable to pay you X amount of money, or should we get a kiosk to replace you? McDonald's is now answering that question in certain situations. They're putting up kiosks rather than pay what the wage is for. And this is a big company phenomenon, but they're the one who they're the canary in the coal mine. When the big companies start doing this, the small companies will still have to pay people because they can't afford this technology. But it's canary in the coal mine stuff when McDonald's. Who else did it recently? We talked about it maybe 4 shows ago. Wendy's? Taco Bell? Somebody else did it.
Well, Wendy's was going down that
testing
path too.
kiosks.
Yeah. Hey,
Panera?
Panera already has kiosks. They still have. I go into the local Panera here, and they have more ways to order without talking to somebody than they do. They only ever have one or two order takers, and they have, I think, 5 or 6 kiosks to order at.
I go to Wow Bao over by the Board of Trade, by the Chicago Board of Trade once in a while, and I use their kiosk. I don't talk to the person. And I can even tap the screen with the corner of my debit card.
I forgot to ask you, Bob, what's your take of GE leadership change?
Necessary is the worst performing stock in the Dow and in the S&P over the last 5 years, maybe longer. It's needed. I think it was, listen, I'm not going to be like Jim Cramer. I love Jim Cramer. It's a great CEO, doing great things. What do you know about the lumber pulp business to say this guy's a great CEO? He only judges it by the price movement of the stock. So I'm going to say that it's a great move because GE's stock has been awful. If you've owned GE, you've made no money except for your dividend. So I'm going to say it's a good move. Needed to happen.
Well, I'll touch on that because I actually, where their stock's going, they actually have a huge pension issue too.
Yeah.
Talking about the state of Illinois and other states, the GE's pension is underfunded right now. This was from Bloomberg this week, $31.1 billion at the end of 2016, the biggest shortfall among S&P 500 companies.
Mike, what are you seeing in GE in the stock? What is your what?
What is my what?
Today's edition of The What and the Why is brought to you by Motive Wave Software. Motive Wave Software is a well-established developer of easy-to-use, full-featured charting, analysis, and trading software built for the individual trader. Motive Wave offers the best charting tools used by the pros, such as Elliott Wave, Fibonacci, Gartley, Gannon ratio analysis, but it's presented in a very easy-to-use way. Motive Wave has a product to fit any budget and any trading style, and one of the very best features, it's available on Windows and Mac. So go to pathtradingpartners.com right now to get your 14-day free trial, and then visit them at motivewave.com.
Anybody looking to invest longer term in GE, it's right now trading just below its 200 week moving average. It's below all the key moving averages we see. It's trading right 27.58. If this closes below 27, we are watching for a fall to the 25 level. So for anybody interested in longer term for GE stock, even though it's way underperformed, this is not a key place to accumulate it. We'll be watching around the 25 level or slightly lower, but the first target is 25.
Nice. My why is going to cover a little of what I talked about earlier, and it's going to be a little bit of shameless self-promotion. We talked about earlier in the show how we put out some educational cryptocurrency stuff, and we did actually make some trade calls. We did actually say there's a potential long here, there's been potential double here. And I wanted to kind of go into why we feel the price action is even better suited in something like cryptos than it is in traditional markets, and we use it in traditional markets every single time we trade. We've mentioned in the show many times that we trade price action. That's what we trade. That's all we trade. We love to talk about the fundamentals and the stories behind it because they're entertaining, they're funny, they're fun. We have interest in that stuff. But trading is 100% price action based for Mike and I. And there's a reason for that, and that reason is even stronger in cryptocurrencies. In the past, we've mentioned how stock markets have an upward bias for any number of reasons. Rebound. The S&P, essentially, it's impossible. It's mathematically impossible for the S&P to go to zero because when a company gets too small, it gets kicked out of the S&P and they put a bigger one in there that's growing. So as long as the S&P, as long as 500 stocks exist, there'll always be an S&P 500, right? So it's impossible for it to go to zero. We've talked about the stock market having an upward bias. There's similar things going on in other activities. In a show a long time ago, I talked about a move in the sterling yen that was caused almost exclusively by a sushi chain in Japan converting yen to sterling in order to hire more managers in the UK. There's outside forces in all other markets that will affect markets in ways that mob rule and behavioral economics, in ways that behavioral economics does not. Things just happen, and people react to it not knowing what happens. In cryptocurrencies, there's nobody in there hedging. There's no sushi chain converting their yen to Bitcoin. There's no monthly rebalance of the mutual fund that needs to be long Ethereum. There's none of that going on yet. So it is almost exclusively buy and hold and speculation. Almost exclusively. It's probably somewhere in the range of 98.9% is that kind of activity. So because of that, the price is actually controlled by behavioral economics, mob mentality, and psychological factors, which is what price action shows us. Mike and I can look at most of our price action tools that we use that we've researched, I researched, and then Mike researched even further. And we can look at those and go, okay, we see this pattern, it's repeatable, and then behind the pattern, here's the psychology going on that makes it happen. We're able to do that. In cryptocurrencies, it works even better because, again, there are not these other factors that we just simply can't take into account because we don't know when they're going to happen, and we don't know if the people behind it are price sensitive or not. So if you want to learn price action trading, and this is the shameless self-promotion part, you can go to any one of our courses and learn it. And then when you apply it to cryptocurrencies, you will see beautiful things happen. Still not 100%. Past performance still not indicative of future results. But price action in cryptocurrencies is more reliable, in my opinion, than in the other markets that we consistently use the same things in. That's why it is, because there's not these outside forces. It's just simply human emotion. That's why they work.
I have a cryptocurrency trade.
You have a cryptocurrency trade?
Yeah.
Throw it in there at the end of the why.
I will. This is based off a 4-hour chart. Get a
Bitcoin?
close above
Bitcoin or Ethereum?
Bitcoin.
Okay, Bitcoin.
If we get a close above 27.89, watching for a return to the 28.70 level. First target, second target is 29.50.
All right. We're going to do a path chat on it?
We'll probably do a video on it.
Okay.
Okay, give me outro, boys, and I'll cut this monster together.
All right. Well, that's it. Good show. Thanks, guys. And thanks to you guys for watching. I am Bob Iacchino.
And I'm going to go fund some underfunded pensions, and I'm Mike Arnold.